Hello everyone, and welcome to this presentation of the best way to trade tops and bottoms, part 1. This is a Specialist Trading Weekly Stock, E-mini, and Forex lesson. Hello everyone, and welcome once again. My name is Primo. I am the president and founder of Specialist Trading, and this is the first in a series of 2-part webinars where I'll be going over the best way, in my opinion, in which to trade tops and bottoms. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you some performance results using this technique, but please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin this week's stock, E-mini, and Forex lesson. All right, as I stated, we're going to talk about the best way to trade tops and bottoms. And the reason why we're going to be covering it this week is because I would venture to say the majority of all traders, regardless of which market, regardless of which type of style and environment you like to trade in other words, an investor or a short-term trader, I would say the majority of all traders try to pick tops and bottoms in some sort of a way. If something is tremendously overbought in their opinion, they'll like to short it. If something is tremendously oversold, they'll like to buy it. So the majority of traders, and myself included when I first began trading, I make no secret about it, that's the way I traded when I was on the floor. I like to trade tops and bottoms. So right now, the best way, after my 36 years in the business, the best way to trade tops and bottoms is simply to go with them. Now, what does that mean, to go with them? As I stated, most people will like to short a top and to buy a bottom. Well, after trading that way for a number of years, I've really come to the conclusion that the best way is actually, if you perceive a top to be in formation or to be formulating, the best thing is to look for ways in which to go long, because most of the time that top will continue to go higher and higher and higher. A top will not be formed right off the bat. It's the same way with bottoms. Most people will try to find some type of bottom actually too early, and they'll be looking at the wrong signs, and they'll actually try to buy, when in my opinion you should actually look at that as a sign to go and short more, that the market is going to be headed lower, regardless of time frame, regardless of what market you're trading. I think the reason this is because people like to pick tops and bottoms. It's similar to playing the slot machines. Most people think they're going to get really quick and lucky with a quick spin, and they're going to hit the jackpot and pick the exact top or the exact bottom. But just like the slot machines, the market is the same way. It will give you a small number of winners, which will convince you that you're actually doing well. But over the long haul, just like the slot machines, you will actually have more losers than winners. And so periodically you'll get these winners from time to time thinking that you're doing fine. But if you keep a record and actually look at your P&L and see how well you've done picking tops and bottoms, I would venture to say that the majority of traders actually over the long haul will lose money trading this way. And the reason is because for some reason we've all been taught, myself included, that there is such a thing as overbought and oversold, that things tend to go too high and that they stretch the limits too much to the upside, and in the reverse they tend to go too low. Things are way too low and things are going to naturally stop in reverse direction. But here's what I've learned once again over my 36 years of trading, and this is what was taught to me by my mentors. They said, Steve, there is no such thing as overbought or oversold. And this really turned my way of thinking around. I always thought that there was an extreme limit, that things would go up to the upside and to the downside. And they said there's no such thing as overbought or oversold, because we've all seen futures, stocks, Forex markets, they can go as high as they want to. In other words, we can't determine, we can't really pick when they're going to turn around. And they can go as low as they want to. We've seen stocks go down to zero and just totally, gone to the point where that you've lost everything and there's no value at all left in the equity. And we can see just futures and continue to go lower and lower and lower. So it's really statistically not in your favor to try and pick an overbought or oversold level. You should try and learn ways to go with it instead of trying to fight it and trying to stand in front of a speeding train. So I'm going to show you in this first part of this 2-part series the way most people trade, and how really it's not in your best interest to trade tops and bottoms, but simply to go with them. And one of the main things is because we've been taught there is such a thing as overbought and oversold, but really what happens is that we have this small series of winners which makes us believe that we're doing fine until we get this larger number series of losers, which doesn't fare well for our P&L. Now I'm going to show you a technique that most traders use. They use overbought and oversold indicators or oscillators, and probably for one of the most prominent ones is the stochastic. So let's look at stocks now and see how this would have worked if we were using some type of overbought, oversold tool to help us with our trading of stocks. As we see here, here's a chart of Apple going back to just a few months ago in December, and we see here that we've plotted the standard stochastic oscillator. This is with the slow K and the slow D right here in the blue and the red. And anything, the conventional wisdom states that anything over this threshold here of 80 is overbought, meaning that it shouldn't go any higher. This is the overbought zone. Anything below this threshold of 20 is stating that things are oversold, and this is the area you should be looking for a buy opportunity. All right, so as we see here in this chart of Apple, once again, going back a couple of months, this would have worked fine. We have a couple of scenarios here where once the blue line or the slow K crossed above the red line or the slow D, we would have had a very nice opportunity to go long, and we would have had a very nice buy signal in Apple. And then once we got to the overbought area, once this blue line or the slow K crossed below the slow D, the red line, in the oversold area, overbought area I should say, well, we would have sold, and look what happened. We had a very nice tendency for the Apple to go down. And so this was like two great trades. Once again, though, just like the slot machines, they will give you winners with this type of technique every once in a while. But over the long haul, you'll really see how it really doesn't pay to trade this way, because it's always those few trades that you'll give back everything you made. Now we had another scenario right here where we went into oversold territory, so we want to go back to the well once more. It worked for the last two trades. Let's try it again. So you would have purchased roughly right here and gone long Apple. And for the first week or two, well, you may have gotten stopped at. You lost a good 20 points, but then guess what? We had a nice rally, got you back to break even, and we went even higher, about another 20 points. So you're waiting for these oscillators to tell you that you were once again in the overbought area to get out of the trade, but we never really got there, and Apple proceeded to go lower. Well, at this point, you're holding on to position. You said, well, it's worked before, and guess what? We're in the oversold territory again, so I'm going to purchase it again. The lines are crossing, so I'm going to buy some more shares, and once again, we go even lower. But guess what? We're now still in the oversold, so, 3 times in a row in the oversold, it's got to go up. So you decide to purchase some more, and guess what? It goes, kind of skipped ahead, it goes even lower. So once again, you'll see how this technique will work fine a couple of times, but mainly we want to see something that has some consistency, and there's no real consistency to using overbought, oversold oscillators to do our trading to try and pick tops and bottoms. It's a perfect example in Apple. You would have had 2 really nice trades, and I guarantee you would have given everything back on the next 3 trades. Okay, we jumped ahead a little bit. Now here's the E-mini. Let's see how this same technique could have helped us or not helped us trading the E-mini, looking for tops and bottoms. Once again, we're looking at a daily chart going back to December or the beginning of this year, just a month or so ago. And as we can see right off the bat, we have the stochastics, the overbought, oversold indicator here plotted. And right off the bat, once again, we would have had a couple of really nice trades. Here was a trade to go short. You would have sold the E-mini on a daily basis and had a really nice profit of about 30 points. And then once we got into the oversold area, you would have purchased on this crossover of the slow K over the slow D, and you would have had a very nice rally here and a nice trade there where you could have exited, because we are in now the overbought territory. So you said, boy, I've had 2 great trades in a row. Let's keep it going. We have the 2 lines crossing over, so we want to sell at this point, because after all, the market is telling us that we are in overbought territory. So you would have sold here, and guess what? It continued to go higher. So we're still in the overbought area, and we're crossing over again. So let's sell some more contracts. And well, as we see, it continues to go higher and higher until ultimately you're probably going to get a margin call. You're going to have to sell your position for a nice loss here. And really, as he stated, everything you made in these first 2 trades, I can almost guarantee you would have given back in the next 2 or 3 trades. So there's no consistency. Once again, we see here, as my mentors taught me, that there's no such thing as overbought and oversold. This overbought continued for the entire month of January, and then going into the first couple of weeks of February, as we've seen. Does this work in the Forex markets? Well, let's look at the same example looking at Forex markets. We're going to look at an example here in the dollar-yen with the stochastics plotted once again. This is coming into the end of December, beginning of January. Now we're in the overbought territory with the oscillator here, and the lines have crossed. So this is telling us that since we're overbought and the two lines have crossed, according to this simple trading plan, you would have shorted the dollar yen. Well, nothing much happened. In fact, we went sideways, but it's not really going higher, and we're still in the overbought territory. So let's sell some more contracts of the dollar yen. And guess what? It just continues to go higher and higher and higher. Okay? Once again, just like the slot machine, just like gambling, you will have winners from time to time trying to pick tops and bottoms. But over the long run, the losers will measure more so than the winners. So it's not something that we want to be trading. I know this firsthand because this is the way I used to trade my first year or so on the floor. And I would have some great, fantastic months followed by disastrous months where I gave everything back. So when we're talking about the best way to trade tops and bottoms, what is the lesson learned here? Well, the lesson learned is simply never, ever try to pick tops and bottoms, because ultimately, over time, you'll have more losers than winners. It's not a type of strategy or method that has any consistency to it. Now, I know there are some traders that just solely trade this way that make very good livings, but they have some type of an edge, something they're seeing that no one else is seeing that you can't teach. They have this internal chart or this kind of discipline where they can know exactly when to short or when to buy in oversold and overbought areas according to them. But this is something that is really just akin to their feeling, to their own discretionary process. We want to have something more fine-tuned, more cut and dry that all of our traders, all of our members can use. So the lesson learned is never ever try to pick tops and bottoms. Stick with something that is more consistent, something that will keep you in line with what the market is doing rather than trying to fight it. Okay, so as we conclude this week's stock, Emini, and Forex lesson, this is part one of our two-part series, the best way to trade tops and bottoms. Now next week, in next week's presentation, I will show you how you should be trading tops and bottoms. Once you see these tops and bottoms forming, how you actually should be trading or entering or staying out of the market entirely. Okay? Now the best way to trade the markets, once again, is to come to our webinars, view these tips and techniques that I've accumulated over my 36 years, and if you're a member of Specialist Trading, to learn the strategies like the back of your hand. Okay? We want you to really fully understand the process. The best way to do that is to paper trade all of our strategies. So we always recommend to all of our students to paper trade for as long as you see fit, whether that's a week, a month, or even a couple of months. It doesn't matter, just as long as you really understand how the process unfolds in real time. Remember, as we stated, we're not looking to hit home runs the way some traders are looking for by trading tops and bottoms. At Specialist Trading, our edge is the specialist edge, which is consistency. We're looking for a technique or a method which will have us trading 20, 30, 40 years down the road. So that's what we're looking for, and the only way we can get that is through a method or some type of sound trading technique that is consistent. Okay? As we close here, I just want to ask you one last time to view our disclaimer. I showed you some performance results using this particular top and bottom technique, but please remember that we can in no way guarantee that any of these results will be repeated in the future. Thank you so much for attending today. We look forward to seeing you next week with another weekly stock, E-mini, and Forex lesson. Bye-bye.